Welcome to this Auto Enrolment briefing. This presentation gives a brief outline of the main points of Auto Enrolment and suggests action points that agents and payroll bureaus should consider before taking on Auto Enrolment work. If you need more detailed guidance, you should look on the Pensions Regulator website. The address is given at the end of the presentation. Background. Since October 2012 and applying in stages up to the 1st of February 2018, employers come under a new duty to automatically enrol all eligible workers into pension savings unless they're already an active member of a qualifying workplace pension scheme. Once enrolled, workers can choose to opt out of pension saving. However, if they do, the employer must automatically enrol them back into pension savings every 3 years, even if they choose to opt out once again. Certain workers have an entitlement to voluntarily elect to opt in to pension saving, and if they choose to do this, the employer must make available a qualifying pension scheme for their use. Where workers are automatically enrolled or they choose to opt in, a certain minimum level of pension contributions are due, normally from both the employee and the employer. The success of the automatic enrolment legislation will, to a large extent, fall to the payroll department, who have an important role to play in establishing who must be auto-enrolled and from what date, setting up pension contribution deductions within the time limits, applying the correct deduction to the correct amount of earnings, refunding pension contributions within time limits, and controlling the paying over of pension contributions to the pension provider. There is comprehensive guidance on all aspects of auto-enrolment on the Pensions Regulator website. Staging dates. Every employer has been assigned a staging date by the Pensions Regulator. This is the date from which a particular employer comes under auto-enrolment duties. There are different staging dates dependent on the size of an employer's largest PAYE scheme and on when they first registered that scheme. Employers can choose to bring forward their assigned staging date to an approved date. Every employer will need to report to the regulator how they've complied with their auto-enrolment duties. The regulator is writing to all employers at least 12 months in advance of their staging date to give them notification as to when they come under auto-enrolment duties. The regulator has published an online staging date calculator to help an employer find out their staging date. All you will need is your employer's PAYE reference number. Having entered your reference number, the staging date you will see on the screen is based on the size of the PAYE scheme in question on 1st of April 2012. It doesn't matter that the numbers of employees in the scheme may have changed over the interim period. Your staging date will not change unless you choose to bring it forward. The calculator can be found at the address on the screen. Employers who first register a PAYE scheme after 1st of April 2012 are subject to different staging dates. Having a qualifying pension scheme available. Prior to an employer's staging date, they must have a qualifying pension scheme or schemes available into which they can auto-enrol all eligible workers who are not already an active member of a qualifying workplace scheme. It may be that an employer can utilise an existing scheme to meet their auto-enrolment duties, or they may have to amend the existing scheme rules to ensure the scheme is a qualifying one, or the employer may have to arrange for a totally new qualifying pension scheme. A qualifying scheme can be a defined benefit or final salary scheme that meets the minimum requirements, or a defined contribution or money purchase scheme that has at least minimum contributions. Bear in mind, not all pension providers will accept auto-enrolment business, even if they provide the current pension scheme. Assessing the workforce. Prior to an employer's staging date, they must assess their workforce so they identify their auto-enrolment duties on behalf of each group. Workers. The first step is to identify all workers in the organisation. A worker is anyone who ordinarily works in the UK under a contract, whether written, verbal or implied, someone who has contracted to provide services to the engager personally and they cannot provide a substitute or subcontract the work. A job holder. A job holder is a worker who is aged at least 16 but has not yet reached age 75, works or ordinarily works in the UK, and to whom qualifying earnings are payable. Eligible job holder. An eligible job holder is a worker who is aged at least 22 but hasn't yet reached state pension age, works or ordinarily works in the UK, and has earnings that exceed the earnings trigger in the relevant pay reference period. Where a worker is an eligible job holder, the employer is obliged to ensure that person is enrolled as an active member of a qualifying pension scheme, even if afterwards they decide to opt out of pension saving. The employer also has an obligation to make pension contributions on behalf of an eligible job holder. At an employer's staging date, they may well have employees who are already active members of a qualifying workplace pension scheme. All the employer will need to do is to monitor such employees in case they can opt out of being a member of a contractual pension scheme. In this case, it's quite possible that the employer will come under auto-enrolment duties in respect of that employee and may have to re-enroll them back into pension savings, even though they voluntarily choose to opt out once again. Non-eligible job holders. A non-eligible job holder is a worker who is aged at least 22, not yet reached age 75, works or ordinarily works in the UK, and has qualifying earnings payable by the employer in the relevant pay reference period that are above the lower limit of the band of qualifying earnings but below the earnings trigger for auto-enrolment. Or the worker is aged at least 16, hasn't yet reached age 22, or has reached state pension age, not yet reached age 75, works or ordinarily works in the UK, has qualifying earnings payable by the employer in the relevant pay reference period that are above the earnings trigger for auto-enrolment. Under the pensions reform legislation, the employer is not obliged to auto-enrol workers who are non-eligible job holders. However, these job holders can choose to opt into pension savings, if they wish, by giving their employer an opt-in notice. On receipt of a valid opt-in notice, the employer must enrol the non-eligible job holder into a qualifying pension scheme by following the automatic enrolment process, setting up pension contributions for both the job holder and the employer. This means an employer will need to make a qualifying pension scheme available for such job holders. Entitled worker. An entitled worker is a worker who is aged at least 16 but hasn't yet reached age 75, works or ordinarily works in the UK, has qualifying earnings payable by the employer in the relevant pay reference period that's below the lower limit of the band of qualifying earnings. Entitled workers do not need to be automatically enrolled. However, they do have a right to join a pension scheme. This can be a different scheme to the one their employer may be using for auto-enrolment purposes. If an entitled worker chooses to join a pension scheme, they must do so by giving their employer a joining notice. The employer must then arrange membership of a scheme for them. The employer will have to deduct contributions on behalf of the entitled worker and pay these into the scheme. However, the employer does not have to pay into the scheme themselves unless they choose to do so, or they've chosen a suitable pension scheme that requires an employer contribution. Automatic enrolment thresholds. An employer has a duty to auto-enrol an eligible job holder who, all other requirements being met, has earnings that exceed the earnings trigger for a particular pay reference period. Where workers are enrolled into pension savings and pension contributions are due, these are based on a percentage of the scheme member's qualifying earnings between a lower and an upper limit. For the tax year 2014-15, the auto-enrolment thresholds are shown in the table. Note, for the tax year 2014-15, the earnings trigger is the same as the PAYE threshold. The lower and upper limits of the band of qualifying earnings are the same as the lower and upper limits of Class 1 National Insurance. Ongoing monitoring of the workforce. A particular worker may be a non-eligible job holder because despite meeting all other requirements, they do not have earnings that exceed the earnings trigger. However, if because of a spike in their earnings, they have earnings that do exceed that trigger for a particular pay reference period, then the employer may need to take steps to auto-enrol them into pension saving. Alternatively, a particular worker may be a non-eligible job holder because they have not yet reached age 22 and have not chosen to voluntarily opt into pension saving. The employer can have a duty to auto-enrol such a worker from the date that they reach age 22. A similar situation arises when an employee reaches state pension age, except that they may no longer qualify as an entitled job holder. Therefore, it's likely that payroll will be involved in the continual monitoring of the workforce. Postponement periods. To help an employer better administer their auto-enrolment duties, they can use specified postponement periods. A worker postponement period allows the employer to postpone the date from which they must enrol all eligible job holders from the employer's staging date or from the date a newly employed eligible job holder is taken on. An eligible job holder postponement period allows the employer to postpone the date from which they must auto-enrol a non-eligible job holder who becomes an eligible job holder. For example, their earnings exceed the trigger or they reach age 22. In all cases, the employer cannot postpone an auto-enrolment date beyond 3 calendar months following the date an eligible job holder should have been auto-enrolled, but for the application of the postponement period. Within this time limit, the employer is free to use whatever length of postponement period they like. Where an employer is using a qualifying defined benefit workplace pension scheme to meet all of its auto-enrolment duties, the employer can use a transitional postponement period. This means the employer can postpone auto-enrolling eligible job holders into a defined benefit scheme until no later than 30th of September 2017. Note, during any postponement period, an eligible job holder is entitled to opt in to pension saving. Informing workers. An employer has a number of information duties concerning its workforce. At the staging date, inform all eligible job holders who are active members of a qualifying workplace pension scheme that the scheme in question is a qualifying one. To inform all eligible job holders who are not already active members of the qualifying workplace pension scheme that they have been auto-enrolled and what they need to do if they voluntarily choose to opt out of pension saving. To inform all non-eligible job holders what they need to do if they choose to opt in to pension savings. And to inform all entitled workers what they need to do if they choose to join pension savings. Notification needs to be given within 6 weeks of the staging date, except for those who are already in the scheme where the notice has to be given within 2 months. At an eligible job holder's auto-enrolment date, when they become newly employed or become an entitled job holder, you must inform the eligible job holders that they have been auto-enrolled, what they need to do if they voluntarily choose to opt out of pension savings, and that notification is to be given within 6 weeks of the auto-enrolment date. When an individual chooses to opt in, you must inform the job holder or entitled worker what they need to do if they choose to subsequently opt out of pension savings. And that notification must be given within 6 weeks of the original auto-enrolment date. Whenever the employer uses a postponement period, you must inform the worker to whom the postponement period is being applied as to when that period ends, what they must do if they choose to opt into pension savings during the postponement period, and that notification must be given within 6 weeks of the date they are enrolled into pension savings or they join pension savings. Once any postponement period has ended and the eligible job holder in question must be auto-enrolled, the employer will also have an information requirement as previously defined. Information about individuals who have been auto-enrolled or opted in or joined pension savings should be provided to the pension provider within 6 weeks of their enrolment date. From 1st of April 2014, the information deadlines are extended from 1 month to 6 weeks. Opting out of pension savings. Where an individual has already been auto-enrolled or after a worker has chosen to opt in or join pension savings, they have the right to opt out. The worker's opt-out notice should be in writing and there is a suggested format it should follow. The opt-out notice should be obtainable from the pension scheme administrator, not the employer, even if it is returned to the employer to action. But employers are free to customise the notice as long as it contains all the specified information. Where, for example, a valid opt-out notice is returned by an eligible job holder who's been auto-enrolled, as long as it's received within the later of 1 calendar month of the job holder's auto-enrolment date, or 1 calendar month from when they received the auto-enrolment information pack from their employer, then the job holder is entitled to a refund of any pension contributions they may have made. Opting into pension savings. Where the employer uses, for example, a worker or entitled job holder postponement period, the worker affected is entitled to opt into pension savings during that postponement period. A non-eligible job holder is also entitled to opt into pension savings where, for example, their earnings are high enough, but they've not yet reached age 22. Where an opt-in notice is received, the employer will check the worker's eligibility and enrol them into a relevant pension scheme. They should do this in the current pay period or the one following if the opt-in notice is received too late to action in the current pay period. Once a worker is enrolled into a relevant scheme, it will be necessary to inform the worker in writing that they have been enrolled and what they need to do if they choose to opt out of pension savings. This information should be provided within 6 weeks of the date the worker is enrolled. Pension contributions. There are minimum pension contributions to a qualifying scheme under the pensions reform legislation. Normally the contribution is split between the job holder and the employer. However, the employer can meet all the minimum contribution or more than the amount shown in the table. The percentages are based on the job holder's band of qualifying earnings. Contributions are only required once the lower limit is exceeded, and no more contributions are required once the upper limit is reached. For auto-enrolment purposes, qualifying earnings include salary, wages, commission, bonuses and overtime. Also statutory sick pay, statutory maternity pay, statutory paternity pay, both ordinary and additional, and statutory adoption pay. This is an exhaustive list. There are no further additions or omissions. Paying pension contributions to a pension provider. Legislation requires employers to pay over auto-enrolment pension contributions by the 22nd of the month, following the one in which the contributions were made, if they're making electronic remittances. This is the date by which the payment must have cleared the pension provider's bank account. Or the 19th of the month following in all other cases. For example, we are paying by postal cheque. This is the date by which the employer's cheque must have reached the pension provider. Whether the 19th or the 22nd falls on the day that is a weekend or bank holiday, then the payment date is the last bank working day before the 19th or 22nd. With respect to pension contributions made during the period between an eligible job holder's auto-enrolment date and the end of their opt-out period only, the payment deadline is extended to the end of the second calendar month, following the month in which the auto-enrolment date fell. This is to enable the employer to have available a refund of pension contributions should an eligible job holder choose to opt out of pension savings within the time limit necessary to be entitled to a refund. Where no valid opt-out takes place, the contributions will then be remitted within the extended deadline. Re-enrolment back into pension saving. Where an eligible job holder has chosen to opt out of pension saving, their employer has an obligation to automatically re-enrol them back into a qualifying pension scheme around the 3-year anniversary of the employer's staging date. This applies as long as the worker is still an eligible job holder at the re-enrolment date. At the re-enrolment date, it will be necessary once again to inform the eligible job holder in writing that they have been auto-enrolled and what they need to do if they choose to opt out once again from pension savings. This information should be provided within 6 weeks of the re-enrolment date. At the re-enrolment date, it will also be necessary for the employer to report to the pensions regulator as to how the employer has met its re-enrolment duties. For further information, there is more detailed guidance on each of the subjects covered available on the pensions regulator website at the address shown.